Welcome to another tutorial video. We are going to go through comparable company analysis, also known as comps or public comps in this lesson, and explain what it is, why it matters, and how you can do it efficiently, even if you don't have access to expensive subscription services or other paid sources. So we've referenced valuation multiples, comparable companies, public comps, and other similar terms in many of the tutorials here, but we haven't defined exactly what they mean. So we're going to go through all that here and explain why these terms collectively matter, and also how to complete the analysis quickly, cheaply, and efficiently in this tutorial. Our plan here is to start by covering the meaning and talk about what comparable company analysis means, why we use it, and how it's different from other valuation methodologies. Then we'll go through the process, the set of steps that are required to use this analysis. Then we'll explain how you can complete it quickly and cheaply on your own, even if you don't have Capital IQ or FactSet or some other subscription service. And then finally, we'll talk about why this process gets more complex in real life, what makes it so time-consuming, and some of the small things that can add up and make something that could take minutes or hours actually take days or weeks when you do it in real life. Let's go into part one first and define what comparable company analysis means. The idea here is that you calculate a company's implied value, what you think it should be worth, based on what other similar companies in the market are worth. So, for example, if a company you're analyzing, company A, has an enterprise value of 1,000 with an EBITDA of 100, and therefore an enterprise value to EBITDA multiple of 10x, you might create a set of other similar companies in terms of industry and financial size and geography. You find that these other similar companies have enterprise value to EBITDA multiples between 11x and 13x. Therefore, company A should also trade at enterprise value to EBITDA multiples between 11x and 13x. And so its enterprise value should be 100 times those multiples, giving you values in between 1,100 and 1,300. So that is the basic idea here. Unlike a DCF, which is mostly based on your views of a company and its long-term prospects, comparable company analysis is based on the market's views of the entire industry or sector. And your assumption is that the company you're analyzing should trade in line with those other similar companies in that industry or sector. And if it is not, then perhaps it is undervalued or overvalued. So it's a relative valuation methodology, which means that it's useful if the market is actually right about those other companies, and it's not so useful when the market is wrong about those other companies, which does happen a fair amount of the time. As a result, we tend to think about comparable company analysis as a supplemental methodology rather than true valuation. Yes, the discounted cash flow analysis has issues as well, but if you set it up properly and you make plausible and defensible assumptions, it usually works reasonably well. Let's go into part two now and talk about the set of steps to follow when you complete this analysis. As we go through this, I'm also going to pull up a simple analysis here for Steel Dynamics, which is one of the companies featured in our case studies, and show you what this looks like in Excel. To value a company with comparable company analysis, you follow this set of steps. First, you select an appropriate set of comparable public companies. These have to be public companies because that's the only way to establish multiples like enterprise value to EBITDA easily. You can't mix and match private and public companies here. These have to be all public companies. Then you determine the metrics and multiples that you want to use to analyze these companies as they relate to your company. Then you calculate those metrics and multiples for all the companies, and then you apply the median or sometimes the 25th percentile or 75th percentile numbers from the set to your company to estimate its implied equity value and implied enterprise value, and if it is a public company, eventually its implied share price. Let's go into step one here first and talk about how you select the public comps or the comparable companies. You normally select them based on geography, industry, and financial size. Ideally, you want about 5 to 10 companies in the set. If you have 50 companies, that's too many to be useful. They can't possibly all be comparable to yours. And if you only have 1 or 2 companies in the set, that's probably too little data to be useful in most cases, and it's too subject to outliers. So in our example for Steel Dynamics here, if you look at it in Excel, we have US-based companies, so that's the geographic criteria. They are steel manufacturing companies, that's the industry criteria, and then projected revenue between 1 billion and 20 billion. So that is the financial size. Now this is a very wide range, but it's still much better than having all steel manufacturing companies in the US, or making it 1 billion plus, or less than 20 billion, or something even wider than this range. This matters because you want companies in this set to have similar discount rates. In other words, you want the risk and potential return profiles of these companies to be roughly similar. This goes back to one of the most important formulas in finance and valuation, which is that company value equals cash flow divided by the discount rate minus the cash flow growth rate, where the cash flow growth rate must be less than the discount rate. So if companies in a set all have similar discount rates and similar cash flows, then differences in their multiples must be explained by differences in the cash flow growth rate. And that's what we're getting at here. We want the cash flows and the discount rates of these companies to be similar so that growth rates and growth differences can explain differences in multiples. Our goal is that if one company has a higher expected growth rate, it should trade at higher multiples. Now, of course, there are many reasons why this doesn't happen in real life all the time, but that is the goal of this analysis. Now, in step 2, you have to figure out the metrics and multiples that you want to use. Usually, you want one sales-based metric and then 2 profitability-based metrics. Or it could be one sales-based metric and one profitability-based metric. It doesn't really matter, but you usually want to look at least sales and profitability and their corresponding multiples. So, for example, you could look at revenue, enterprise value to revenue, and revenue growth to establish a correlation between the multiple and the growth rate. You could look at EBITDA, enterprise value to EBITDA, and EBITDA growth to establish a correlation there. And then you could look at net income, price to earnings, and net income growth to establish some type of correlation there. In terms of time periods, you usually want to use a mix of historical and projected ones. A common approach is to take the last fiscal year or the last 12 months and then the next 2 projected years. Historical numbers are good because they're based on what actually happened in real life, but they can also be distorted by acquisitions, divestitures, and other one-time items. Projected numbers are good because they're normalized and they don't factor in those types of one-time items, but they're also projected numbers, which means that they may or may not actually happen. Here, we focus on revenue and EBITDA and also look at EBITDA margins to assess just how similar these companies are. So we have revenue on a historical and projected basis, EBITDA on a historical and projected basis. We have net income on a historical and projected basis. And then we look at our projected revenue and EBITDA growth rates to establish a correlation between these rates and the enterprise value to revenue and EBITDA multiples down here. We also look at EBITDA margins just as a way to see if these companies are really similar. It would be slightly concerning if one company had a 30% margin and all the rest had 5% margins, for example. But here they're in roughly the same range overall. And we also look at PE multiples, although they're a little bit less meaningful in this case because they're a bit all over the place. So that's step 2. Then in step 3, you have to calculate the metrics and multiples that go into this analysis. So you start by calculating each company's equity value and enterprise value based on its current share price, shares outstanding, and the items on its balance sheet. If we go into our analysis here and look at what we did, let's just take a look at one of these companies as of the time we completed this. So for United States Steel, for example, we simply took its share price and multiplied by its diluted shares outstanding, which we got from its filings, and that gave us the company's equity value. Pretty standard calculation. To move to enterprise value, we then looked at the company's balance sheet and we took its equity value, we subtracted cash and other non-core assets, we added debt, preferred stock, and non-controlling interest, and that gave us the company's enterprise value. So that's the first part that you complete for each company. Then you have to get the historical figures for revenue, net income, and EBITDA, and whatever else you're using from the filings or from online sources. Here, we just looked these up quickly in United States Steel's filings. So we got all these on a last 12 months basis from there. And then for the projected numbers, you can find these in equity research, or as you'll see in a little bit, you can also look them up for free in some online sources and sites that track this type of thing. So for the projected revenue, in this case study, that's exactly what we did. Same for projected EBITDA and same for projected net income. And then once we had all that, we calculated the growth rates, the margins, and the multiples for this company. There isn't really much to say about this. This is simple arithmetic, which I hope you understand if you're watching this. To calculate the projected revenue growth, we take revenue in 1 year and divide by revenue in the previous year and subtract 1. To calculate the multiples, for the enterprise value based ones, we just take our enterprise value and then we divide by our EBITDA in the relevant year. And then we went through this process for all these companies here. So after we finished it for United States Steel, we moved down to Nucor, then Commercial Metals, then AK Steel Holding, Worthington Industries, Reliance Steel, and so on. And we already had our numbers for Steel Dynamics from another part of this model. So that's it for step 3. Then in step 4, you need to apply these metrics and multiples. You start by calculating the minimum, 25th percentile, median, 75th percentile, and maximum for each version of each multiple. So here, for example, if you look at what we did, if you look at the LTM enterprise value to revenue multiple, we took the maximum, the 75th percentile using the quartile function, the median, the 25th percentile with the quartile function, and the minimum. And we also calculated the number for Steel Dynamics. So this gave us a sense of what this set of comparable companies looks like. Then we applied each multiple. We multiplied each multiple by the applicable company figure to get the implied equity value or implied enterprise value. If you go over to the val sum tab here, you can see this. We simply link to all these multiples right here using the transpose function. We link to Steel Dynamics figures as well. And then to get some of these numbers, we started by getting our implied equity value by taking the company's net income from fiscal 2017 and multiplying by the median multiple for that period. That gave us our implied equity value down here. And then we simply divided by their share count to get the implied share price according to this multiple, the PE multiple in this period, fiscal 2017. We went through a similar exercise for all the rest. For the enterprise value based ones, it's similar. We just take the applicable figure and we multiply by the relevant multiple. But the difference is that to get to the implied share price, we have to follow the normal equity value to enterprise value bridge backwards and then divide by the diluted share count down here. So that's how we did this. And at this point, we could also make some type of graph or chart to sum this up, but we're skipping that here to save a bit of time. And as I write right here, you back into the implied equity value if you need to, and you divide by the share count to calculate the implied share price. The overall goal in this analysis is to be able to say something like Steel Dynamics might be worth between $15 and $20 per share according to revenue multiples, or between $17 and $23 per share according to EBITDA multiples. And if you look at the results that we get, they seem to be decently close to that result. If you look at the 25th percentile to 75th percentile for the EBITDA multiples, it goes from about $11 or $12 per share up to about $26 or $27 per share. So we could say it's valued at something in that range, or we could make it a little bit narrower and make it go from 15 to 22 or 23 or something like that. And then for the revenue multiples, similar idea. It goes from about $9 or $10 per share all the way up to $28 per share. So if we take the midpoint of that range, it would probably go from about $13 up to about $24 or $25. But something like that is what we could say based on these numbers. So that's it for the process and how this looks in Excel. Let's now go into part 3 here and talk about how to complete a comparable company analysis quickly and cheaply. The fastest solution here is to use a free screening and stock research site like FinViz, Zacks, or Motley Fool to find the companies and to find basic financial information. We're going to use FinViz in most of the examples here, but if you want to, you could certainly use Zacks. You could search for Zacks Stock Screener and you could look up the industry there and you could enter financial criteria to find companies. And then you could click through and actually look at companies like Steel Dynamics here. And then you could go down and you could look at industry analysis, for example, and you could find the comparables like that. And then you could click through and click into them. And then you could also find the projections for the company like that as well. But sticking to our example with FinViz here, usually the path of least resistance is to search by the name of the company you're valuing and then click through to the industry section or the industry name to find peer companies. So with FinViz, for example, if we enter STLD for Steel Dynamics, that's their ticker, we get a page that lists all the financial information for them. If we then click on steel and iron right here as the relevant industry, we can see all these companies. Now, this is not very useful because we want to sort these companies in some way. Unfortunately, on FinViz, there isn't an easy way to sort them by revenue, which is normally what we want to do. But if you sort by market cap, for example, you can usually get a decent proxy for what that looks like. So I'm sorting by market cap here in descending order, and we can see that we get many of the companies that we had in our set of comparables. Nucor, United States Steel Corporation, Worthington Industries, for example. And if we click through on some of those, Nucor, for example, we get all their financial information. So we get their market cap, we get their sales figures, in other words, their revenue, It doesn't give us all the balance sheet information, so we'll have to do a bit of work on our own. They also give us the projected EPS figures as well, so we can get a lot of the information from there. You can also click on financial highlights right here and also statements to get more information on the company. So if we click on financial highlights, for example, we get consensus estimates right here, so we can get sales and EPS estimates from this site for free on Reuters. And then if we want to get their historical financial information, we can click on income statement, balance sheet, and cash flow statement on this MarketWatch site and pull in a lot of the numbers from right here. So you don't need an expensive subscription service to go through this process. You just need to use one of these websites. As I said, screening and sorting is a bit annoying here, but sorting by market cap tends to work well when you're doing this. And then for the projected numbers, click through to financial highlights or statements to find them. One issue is that these projections tend not to have EBITDA, EBIT, and other figures like that, usually just revenue and EPS. As a simple solution, you could just assume that EBITDA grows at about the same rate as EPS in future periods if you need to get this. They're both profitability-based metrics, and although they are different, usually there's some relationship between them. So here, for example, we could look at the EPS growth for Nucor. They're saying that in the next year, it's going to decline by 14%. So if that's true, then EBITDA should probably decline by some amount as well. Maybe not 14%, maybe 10%, 15%, something like that. And we could use that to quickly come up with estimates for EBITDA and other figures for this company. Another problem is that there isn't an easy way to download all the data in one spot or to pull all the numbers into Excel quickly and simply when you do this, which is why you don't want to have 25 or 50 or 100 companies in your set. This is really why you want to limit it to 5 to 10 companies as well. Another solution here might be to look at some browser plugins. There are plugins for Chrome and Firefox and other web browsers that let you download information on a web page into an Excel or comma-separated value CSV file. So that might be another option to do this more quickly and efficiently. In any case, the point is that you do not need a service that costs thousands of dollars a month to find this information. You can easily get quick estimates on these types of websites. Let's now go into the last topic and talk about some of the added complexities that come up when you perform this analysis in real life. The first thing to note here is that oftentimes in real life, you will actually have to search through the company's filings manually and find all these numbers. You won't be able to just use automated services or websites like Reuters or MarketWatch or FinViz like I just showed you. Another issue is that you will often have to search for something called non-recurring charges when you do this exercise. So it can be quite difficult to determine whether or not certain items like restructuring should be added back when you calculate EBITDA or EBIT. Because the question is it really non-recurring, or is it actually just a normal item that the company chooses to label non-recurring, but which is actually more of a normal business activity for them? And then finally, you often have to calendarize the figures. If one company's fiscal year ends on June 30th and another's ends on September 30th, you can't really compare those figures directly. You have to make sure both companies have years ending on the same date. So for example, you might have to take the July 1st to June 30th numbers and then add the July 1st to September 30th numbers from this year, and then subtract the July 1st to September 30th numbers from the previous year to calendarize it and change this company's fiscal year to match up to the September 30th ending one instead. We're not going to go through this in detail, but just to give you a flavor of that, I have up here an analysis for another company, Jazz Pharmaceuticals, where we do that. We calendarize the numbers by adding and subtracting partial periods. We factor in the non-recurring items by manually searching through the filings, and then we do the same thing for everything else. So we're not just automatically pulling these from these types of services online. We're actually going through all the filings and manually entering all the numbers for the shares, the options, the balance sheet data. This makes the analysis take much longer. It is more accurate when you do it like this, but it turns something that could take a few hours or maybe 30 minutes to an hour or so into an exercise that might take you days of time to finish. We're at the end, so let's do a quick recap and summary now. With comparable company analysis, the idea is that if companies A through G are like us, and they have enterprise value to EBITDA multiples of 10x to 13x, we should have a multiple like that as well. So the company we're analyzing should also have a multiple somewhere in that range, and it should be valued at that level as well. We want the companies that we pick in this analysis to have similar cash flows and discount rates, which is why we screen by industry, geography, and size. The overall process is to select the companies first based on those criteria: industry, geography, and size. Then determine the metrics and multiples you want to use. Then calculate them either manually or by using one of the automated services I just showed you. And then you apply them to your company. You apply the medians, or the 25th or 75th percentiles really, to determine your company's implied value. To do this quickly and cheaply, use services like FinViz or Zacks to find the comps by searching for the company you're analyzing and then pulling up peer companies or the industry group and screening. You can also pull basic financial information from there and make estimates of your own when certain numbers are not available. And then finally, in real life, this gets more complicated because you have to manually find information sometimes, you have to look for non-recurring charges, and you have to calendarize the numbers in some cases. That's about it for this lesson. You should now have a better understanding of what comparable company analysis means and how you can do it quickly and easily.